Is now a good time to invest in property, or should you wait? We've been working with investors for well over a decade now, and this is a question we get asked every year without fail. And we can see why people are particularly asking it now, because when prices are stalling, landlords are leaving the market, and a crash is reportedly looming, it's only natural to be cautious. So to help you figure out the right move for you, in this video we'll explore whether the famous 18-year cycle actually predicts what's coming, what waiting really costs in missed rent, growth and opportunities, and how to know if 2026 is the year to make a move or to sit tight. First things first, we need to talk about timing, and more importantly, why everyone's so obsessed with it. Because every investor wants to find the right time to buy. At the moment, interest rates are higher than we'd all spent a decade getting used to, landlords are selling up, and there's constant talk about new taxes, rental reform, and a housing slowdown. So understandably, people hesitate, because they're scared of doing the wrong thing at the wrong time. The last thing they want to do is drop tens of thousands on a property just before the next crash. And that fear is completely valid. Because if you'd bought the average home in London in 2007, you'd have been down by about £50,000 by 2009. No one wants that. But what most people miss is that waiting can be just as expensive. Someone who didn't buy in 2012, thinking it was too soon and prices might fall further, has missed out on over £100,000 in capital growth, plus more than a decade of rent. Even those who paused just during COVID have missed roughly £50,000 of growth and one of the strongest rental markets in memory. So yes, you can get it wrong by acting too early, but you can also get it wrong by sitting still for too long, which naturally raises the question: is there anything we can actually look to as a guide? Now, before I answer that question, one thing you can do is download our free property investing toolkit. You'll get everything you need to run the numbers, structure your deals, and invest confidently no matter what's happening in the market. You can find it in the link below. A few weeks ago, we answered a question in our Sunday Times column from an investor who was thinking about buying, but was worried that the market was at its peak and that a crash could be just around the corner. We're currently in the boom phase and we should have a peak next year with a crash soon after, he said. And to be fair to this investor, he hadn't heard this from some guy down the pub. It actually came from an economic theory that's gained a lot of traction in recent years. It's called the 18-year property cycle, and it's based on hundreds of years of housing data. Developed by economist Fred Harrison, who correctly predicted both the 1990 and 2008 crashes, the theory suggests that the market moves in predictable phases. Around 14 years of growth, a small dip in the middle, and a giant boom towards the end, followed by roughly 4 years of decline. So by counting forward from the last crash, the theory would say that we're now nearing the top, with 2026 marked as the peak before a potential downturn. But when you look at what's actually happening in the market, the data doesn't match the story. If we were truly in a late-stage boom, we'd be seeing runaway prices, reckless lending, and buyers paying whatever it takes to get in. And that's not what's happening. Actually, quite the opposite. Since mid-2022, prices have already fallen by around 15 to 20% in real terms. Nominal prices might look flat, but once you factor in inflation, we've already had a meaningful correction. It just hasn't felt like one, because it's happened quietly, without the headline-grabbing collapse that people were expecting. And in many ways, that silent correction has already done the same job that a crash normally would. The market's cooled, listings are up, properties are taking longer to sell, and buyers suddenly have leverage again. All of which is the opposite of a manic pre-crash environment. That's why relying purely on the 18-year cycle as your timing signal doesn't make sense right now. It's a helpful framework in hindsight, but cycles are easier to map looking backwards than living through them. And even Harrison himself acknowledges that major events like wars, pandemics, or interest rate shocks can completely disrupt the timing. When you look at any data point you can pick, as well as the vibe of what's happening in the world around you, it's pretty clear that we're not in a bubble that's about to burst. We're in a market that's already corrected and is now stabilising. So while waiting for the next big crash might sound sensible, it could well mean waiting many more years and missing out on solid buying conditions in the meantime. But even with all this evidence, plenty of people still feel uneasy about buying right now. And that's understandable, because on the surface, everything does feel uncertain. Interest rates are much higher than the near zero that we'd all got used to. Rental reform is on the horizon. Landlords are selling up, and house prices aren't exactly racing ahead. So it's easy to think, why not wait until things settle down? But the question that I'd ask is, what exactly are you waiting for? Because if it's for everything to feel calm and predictable again, that's not a signal to buy. That's a sign that you've already missed the window. Because back in 2006 and 2021, for example, everyone was enthusiastic about property. Just the kind of conditions that you might be waiting for, with no clouds on the horizon. But when you look at it, these were actually the worst times to buy. And the likelihood of getting burned during one of these periods was significantly higher. So if buying during a boom, when everyone's really enthusiastic, is bad, does that mean that instead you should wait for a crash and get in straight afterwards? Well, theoretically, yes, but it's not quite that easy. Looking back through history, we can see occasional brief windows when it's been a great time to buy. Like 2012, after the crash when prices finally hit the bottom. But at the time, it didn't feel like a great time to invest. Confidence was low, the news was negative, banks were reluctant to lend, and if you told anyone you were going to invest in property, they would have thought you were crazy. We only know it was a good time now because we have the benefit of hindsight. And even if you think you've identified one of these brief, perfect windows of opportunity ahead of time, will you actually have the funds and the nerve to be the only person walking through the estate agent's door when everyone else is panicking? Because going back over past cycles is all very interesting in retrospect, but no amount of clever modelling is going to tell you what the future has in store. But what we do know is that if you don't buy this year, one of two things will happen in the following 12 months. Scenario 1, the market picks up, prices rise, and you've missed the easy wins. Or Scenario 2, the market stays flat, and you're still exactly where you started, but with a year of lost income and no closer to your goals. Either way, waiting doesn't protect you. It just delays progress. The 18-year cycle can't help us mark the perfect buying opportunity on our calendar in advance. But what it does clearly illustrate is that there are only short windows when it's genuinely a bad time to buy. The manic 12 to 18 months before a crash. The rest of the time, it's fine. The investors we've seen have the most success aren't necessarily the smartest or the bravest, but the most consistent. They just avoid the extremes, tune out the constant noise, and act when the deal makes sense. Now, even if you got lucky and timed the market just right, you could still fall victim to expensive mistakes later on. And one of the biggest ones that catches landlords out is tax. That's why you should watch this video next. It shows how experienced investors structure their portfolios to keep more of what they earn. So when you do decide to buy, every pound works harder for you.